Well, the crude crash hitting stocks today, the S&P 500 dropping more than 4.5%. Our next guest says the V-shaped recovery may not be in the cards just yet. Let's bring in Tony Dwyer of Canaccord Genuity. Tony, it is great to speak to you on the phone.
Hey, Mel, welcome back.
Thank you.
Great to have you back.
Thank you. So you actually think things could get worse. What are you looking at that makes you think that?
Well, I think we have to make sure that we know what I'm talking about with the V-shaped recovery. I'm talking about an economic recovery. There's already been a V-shaped recovery. Listening to the panel talk about energy, guess what the number one sector performance is coming off of the low on March 23rd? Energy. So to believe that because the price of oil has collapsed, the stocks are at the same level they were on March 23rd, and there's this incredible opportunity. It's already had a pretty good bounce off the low, just like healthcare, real estate, utilities. The thing that's interesting about the market and the way it's rallied, Mel, and people aren't used to me not being the permabull, but the sectors that are rallying and leading the market off the March 23rd low are not the sectors that led the rally off of the March 03 or the March 09 low. So we're still in the view that, especially given how extreme, we were looking for a relief rally, but not a 30% relief rally. So we're still thinking it's tactical. The fundamental side, Mel, that's interesting is if you look at the yield curve, and how many times have we done the yield curve when we were on set? And the two-year, 10-year U.S. Treasury yield curve, everybody talks about it when it inverts because it's predictive of a recession. It's also predictive of the end of the recession. Over the last three cycles, the yield curve has re-steepened to over 100 basis points. It's currently at 43. It steepens to over 100 basis points, and actually in the last two, it gets up closer to 200 basis points before you emerge from recession. So the yield curve is telling you, by being still so low, that any recovery you get is going to be very tame. So far, that's what the market's saying.
So what does the equity picture look like against that backdrop?
So I wrote a note, and I was going to call it the square root recovery until I realized that it's a backwards square root that I'm looking at. If you think about how the square root looks backward, you had this huge decline. You've had a sharp oversold rally. Now you're in this epic battle between the Fed and monetary stimulus, and that protects, I think on April 9th when they came in to announce they were going to buy high-yield debt, I think that protects the total 2008 credit crisis, we're going to zero kind of mentality. However, the economic reality is on the other side of that. So what I think, Mel, is we're going to get a pullback here, and our call had been to get more offensive because while you were away, we downgraded our market view in January, and our intention, once the panic started and it looked like it was going to end, was to get a relief rally and then followed by a test of the low. I don't think it's going to go all the way back to the low because of the Fed, but I want to become more offensive as we go down and then positive divergences develop.
Karen, you got a question?
I do. I agree with you, Tony, on your general thought that the V-shaped rally was probably too fast. So how far back do you think we retrace before you would say, let's get aggressive again?
It's not the level, Karen, that's really going to drive that decision. It's what groups are outperforming on the way down. So it's the relative performance of the sectors. You want to see the economically sensitive sectors. Like today's a great example. The financials and small caps outperformed. Like that's what you want to see. You want to see the more economically sensitive sectors start to price in stability. Also, I do think you can get down towards 2,500. I think we're going to be in this range. The problem that I have is when I look at how bank lending is acting, I look at how the yield curve is acting, I look at how the Chicago Fed National Financial Condition stress indices are looking. The Fed intervened in the corporate credit market, and that again protects like a total going to zero disaster. But the credit metrics we've talked about so many times on the show don't point to, wow, we're going to have this turn in the economy once we all go back to work, thinking we are going to go back to work. So I think it's back down toward 2,500, but more of a broad range.
Tony, thank you. Great to speak with you.
Thank you, guys. Welcome back, Mel.
Thanks. Tony Dwyer, Canaccord Genuity. Guy Adami, reverse square. I know that's going to take a lot of thinking on your part to remember what reverse square root is, but you agree with that?
I don't even know what I mean. First of all, I changed my backdrop in honor of you coming back to the show.
Very
I hope
modern.
You appreciate it.
Very
it took
Westin
a lot of work.
lobby.
Yes, thank you. Number one. Appreciate. Well, I mean, there you go. Number two, let me say this, and I think Karen might agree with this. You can make an argument that, the market's down, whatever it's down, 15% from an all-time high. Market stocks might actually be a tad more expensive than they were at an all-time high, unless you factor in the fact that we're in the zero rate environment in perpetuity, and then you have to change the multiple. But, it seems like, we're 3 months into this thing, and stocks actually might be more expensive. I tend to favor the Tony camp. I don't know if we're going to test that prior low of 2190, but I think the trajectory now is probably somewhat lower from here. So I would agree with TD.